Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 336th VideoCast podcast for the week ending March 26, 2026. Got a lot of great stuff to cover today, but as always, family first. There's Mimi and Caitlin at ODP. It was an epic weekend for Mimi. She played in the USA Water Polo Olympic Development National Championship. She had some incredible goals, assists, steals. Her super talented team brought home gold, winning the ODP National Tournament. Then we learned that Mimi was picked for the national team selection camp where she will try out for the ODP Pipeline U.S. national team. It's a huge honor, and we're so happy for her. And Annabelle received her official certificates from USA Swimming, commemorating her two national age group records, NAGs, in the 200-yard and 200-meter medley relays. So congratulations on that. We'll pull up a couple of Mimi's quick goals here, and these were pretty awesome. This one here, watch the pass from her teammate. Super awesome job. She could have taken it herself. She passes it, and Mimi puts it away. Boom. Okay, and then you got the second last one here. And watch the pass from the goalie. It's just unbelievable. Boom. She completely set Mimi up here, and all Mimi had to do was put it away, which she did. Absolutely amazing. Okay, next. So here is the national championships and TSC selections amount. Here's Annabelle's age group record with her incredible teammates, Hope, Grace, and Julia. Here's Mimi's team up at the event. Here's the other award for Annabelle, Hope, Grace, and Julia. There's Mimi at the tournament this weekend, and that's that. Then I had the pleasure to be in New York this weekend. There's the booth at the NYSE for those of you who are new. Ashley Mastronardi at NYSE Live. Here's the overall stock exchange. You can see some of the TV setups there, CNBC, etc. And then here is the big money show. Jackie, Brian, Kennedy, she was amazing. Taylor, I learned that Taylor knows jujitsu. Here's Diane King Hall at Schwab Network. Here's the background you can see when we're sitting on the desk at Varney, all the TVs and the teleprompters and everything else. There's also at Schwab, etc. So a lot of great stuff. Then I had the pleasure to join the great Stu Varney on Fox Business, thanks to Maggie Edwards. Also want to thank the incredible team upstairs I got to meet for the first time. Kelly, Sue, Stephanie, and Ralph. Thanks for having me up. Enjoyed that very much. We're going to listen in here.
Have I got a deal for you?
Good choice. Good choice. Have I got a deal for you? We're talking about a deal in the Middle East. Yes, okay. Perhaps we should make them a deal that they can't refuse. That's from The Godfather, folks. All right, let's check futures right from the get-go, shall we? We're looking at some red ink, but it's not huge. The Dow is down about 250. Nasdaq's down just over 100. Thomas Hayes is with me to help me cover the market this morning. The market rallied after Trump announced that 5-day pause on energy attacks on the infrastructure in Iran. You've been buying up tech, haven't you?
Yeah.
And that implies that you think the bottom has already been reached.
Well, we've been buying tech. We've been buying consumer discretionary. What I've learned in this business, Stu, is the pessimist always sounds smart in the short term. The optimists wind up with all the money in the long term.
Do you think we could get a rip-your-face-off rally if we settle the war?
There's no question about it. We saw record purchasing of put options last week, record short volume in the market. Everyone is offsides on this rally. What we found since 1939, 30 geopolitical events, they tend to bottom out 15 trading days into the event. That was Friday. And within weeks afterwards, they tend to resolve massively higher. 12 months later, on average, up 12.93% in the S&P.
To get that kind of rally,
yes,
you've got to have the Strait open. You've got to have no more nuclear enrichment, uranium enrichment by the Iranians, and you've got to get the uranium they've already got out.
You need expectation of those things happening.
Really?
You don't need actually happen. As a matter of fact, the market tends to recover before the event, the fighting is over. So you need some move in that direction, like we saw a taste of it yesterday. I think as we get through this weekend, there'll be a little volatility into Friday because no one knows. Sure. We've got a lot of Marines headed over. Who knows what could happen over the weekend. But I think next week, if
expectation. If you get the expectation, get the rally.
Yeah, you get the rally.
Tom, stay with me for the hour.
Yep,
There's a lot more for you. Alibaba, often called China's Amazon, just revealed a new chip design. Good morning, Taylor.
Good morning.
What's so special about it?
Well, what's so special is Alibaba's doing it. It's a new chip for agentic AI and inference computing. A complicated name that I won't try to pronounce, but what's interesting is this chip allows users to sort of structure it to do specific inferencing use and really tailor it to the individual user.
Doesn't sound like it's a big deal.
It is a big deal.
Oh.
This is a big position we've had for a while, from $82.
Oh, you're talking your book.
They have had triple-digit AI revenue growth for the last 10 consecutive quarters. This is still the cheapest AI play in the world.
Oh, not bad.
Yeah.
Good information there. Thank you. Are we on the verge of a credit crunch? Or
No.
a run on these?
This is going to be a big problem, just not now. Warsh is going to come in. He's going to lower rates regardless of the short-term data. They're going to get bailed out for another few years. This will be a problem down the road because they have mark to make believe. They market where they want to market until they market at zero. But with lower rates, they'll be able to roll a lot of this debt, and it'll be a problem down the road. Kick the can down the road.
Oh, let's do that.
Yeah, exactly.
All right, Tom, you brought some stock picks with you this morning. VF Corp.
Yes, consumer discretionary, most underweight since the October 2022 lows. Managers have no exposure, never bet against a U.S. consumer when they have a job. Our unemployment rate is still 4.4%. Bracken Darrell is the CEO. He turned around Logitech. It was a 26-bagger in just under 10 years. He's doing the same thing at VF Corp. This is Vans, Timberland, North Face. He sold off Dickies and Supreme to deleverage the balance sheet. We believe this stock can be a double or triple over the next 3 or 4 years. They are returning to growth with 75% of their portfolio back to growth, up from 10% just a year ago.
All right, Tom, stay there. More for you later.
Yeah.
Thomas, are you a fan of the cryptos if they get the right legislation?
We prefer productive cash flowing assets. However, if you put a gun to my head and you said, choose one, Tom, I would say, Bitcoin is non-productive. Ethereum is being used by major institutions for tokenization and settlement. JP Morgan, Fidelity, BlackRock are using Ethereum as their platform. So gun to my head, that's the one I would choose, Stu.
Ethereum's not done well, actually.
Yeah, I like the underdogs.
Yeah. Well done. Tom, thank you very much indeed. Thanks for being with me for the hour. Appreciate that.
And we're back. And then I had the pleasure to join also for the full hour. Varney was for the full hour. We cut out the key points. The Big Money Show. And again, that's I want to thank Anastasia Kavunis for having me on. And of course, Brian, Jackie, Taylor, and Kennedy will listen in here.
Welcome to the Big Money Show. I'm Brian Brenberg, along with my co-host Taylor Riggs, Kennedy, Jackie DeAngelis, and with us for the hour, Great Hill Capital Chairman Tom Hayes. Good to see you, sir.
Great to be here.
So are we in for another week of wild market swings, or could calmer waters be ahead? Tom, you got your rally cap on today. Are you feeling like this is the beginning of something good?
I think this is very much like the tariffs. It started with a tweet. It ended with a tweet. There are a lot of short sellers this morning that are applying for jobs as Walmart greeters. They're out of business. And the game is on. I mean, look, if you bought an apartment building 2 months ago for $1 million and someone offered you on Friday $800,000, and you'd say to them, you're absolutely crazy. Why would I sell? The rents are still coming in, et cetera. And yet in the stock market, many people did that. If you looked at the volume, the selling volume on Friday, we haven't seen that level of selling volume since the COVID lows, when we didn't know if we were getting a vaccine, we didn't know what was going to happen. Put skew, the amount of people buying insurance on the stock market after the house was already on fire, was at record levels. Again, going back to the COVID lows. If you're not buying on red days, at least nibbling a little bit when prices are that dislocated, trusting that things will work out. Maybe they weren't going to work out in 48 hours, but maybe they were going to work out in 6 weeks or 3 months. Good companies with cash flow, then you really miss an opportunity. So I would say that there are opportunities in the market right now. Yes, the market's up a lot today. Maybe we'll see a little volatility throughout the week as we get into Friday. But if Trump is done, he's set back Iran at least 5 years from their nuclear ambitions, if not a lot longer than that. It's kind of mission accomplished. Get the Strait open. Let's go.
Tom kind of coming down hard on these sellers, Taylor. What are you reading in the markets today? We're off the highs of the day. You know, the Dow's is up 730. We were up over 1,000 earlier. What's your kind of like how quick things bounce back with Hormuz timeline right now?
I think if you see a few ships going through, the market's going to just rip higher. I mean, back higher. Because what's been odd about this...
Oil's going to go lower.
Oil's going to go lower. Stocks are going to go higher, aggressively higher. Because while this has been going on, Atlanta GDP now is 2.5%. Okay, it's nowhere near a recession. Earnings estimates have continued to go up every week throughout this. Not to say that that would have continued in perpetuity. We were all looking for when do estimates start to come down because this is dragging on. But if this week is done, I mean, we got 15% earnings growth going into next year, 11% for this quarter. So a lot of positive things. If this drags or drags. What's that?
Nancy Pelosi at 70.
Yeah, she's up 100.
The great Charles Payne was on earlier this morning, and he was saying these markets wanted to rip before this, and they still want to rip. So they're just kind of waiting it out.
Yeah.
And if you think about it, there were some great stocks on sale, especially in the tech space, that have gotten hammered. So smart money was probably looking and bargain hunting here.
Yeah, and the other area, the most underweight since COVID was consumer discretionary, because consumer sentiment has been in the tank.
And Kelly Osbourne.
And that. And you're seeing them this morning. A lot of consumer.
To look up that reference in the break.
You'll appreciate it when you see it. You'll understand.
Yeah, I get the joke. A lot of consumer discretionary, because consumer confidence will whip back very, very quickly if gas prices come down, and this gives enough runway into the election. But this thing dragged on another 2-3 weeks. I mean, it was almost a guaranteed formula: lose the House and possibly the Senate. And I don't think he wants 2 years as a lame duck.
I got it. You excited about this?
I think it's innovation. I think he's Thomas Edison of the modern day. I think he's brought a lot of hope, a lot of new technologies to mankind, and I think it's a good thing. We need more like him. Well, I think today the most important thing airline stocks are paying attention to is the price of oil, and you're seeing all the airline stocks up today. I think President Trump articulated that there are fail-safes in place between bringing the ICE agents, possibly bringing in the National Guard, and then possibly having Elon write the checks for the salaries, at least for the critically important people with specialized skills. But I flew yesterday from John Wayne. I showed up 3 hours early, and it was pretty seamless, and all the amazing TSA workers, which I'm very grateful for, they all had really positive attitudes. They were very gracious. They're kind of heroes, really, to show up in this environment and do that for their fellow citizens. Is kind of moving, actually, to see it. So it went pretty well, and I think President Trump will make sure that it continues to go better than some of these longer lines like we saw in Atlanta, like maybe a little bit in Newark over the weekend. And on that basis, I don't think it's going to have a material impact on the economy. And I think with spring break coming up, to your point, there's going to be a lot of urgency to get it done, and they'll figure it out. Well, here's the thing. I mean, in California, they get away with it because you got palm trees and 65-degree weather 365 days a year. Here, what do they have to offer? And money goes where it's treated best. We see it going to Miami. We see the stock exchange going to Dallas. We see the billionaires leaving. And that's going to continue to happen until you get a 1970s scenario where bargains become big enough that money comes back in because the prices just got too low. So if this guy continues, it'll create opportunity, but it's going to be a lot of pain in the interim.
Yeah, the opportunity is not in New York State. It is not in New Jersey. It is not in California.
That's right.
They're taxing people and giving them a good, swift goodbye.
I can't believe I'm going to say this, but I think it all needs to be regulated. I'm Mr. Anti-regulation. This is crazy town. I mean,
I'll bet you $1,000 you don't really believe that.
I'll
take that.
But Kennedy, what about the deal?
I'll take that on 2-to-1 odds.
What about the deal of like betting on whether a guy's gonna? Tom, I flew you out here on my own dime to tell the Papa John story today.
Listen,
and I'm still
Tom
down.
said in the break you need a year.
Yeah, this contest needs to be extended by 12 months. Then I'm going to bet on Brian on the prediction market that he's going to win this contest, because Papa John's, you got Todd Penegor. He came from Wendy's. He turned around Wendy's for Nelson Peltz. 3-bagger in the stock. He brought in the guy from Domino's who
who did the digital app for Domino's, had a 12-bagger while he was there. They're number 1 and 2 in 11 of the 15 top markets, 5.2% dividend yield while you wait. And then you've got these Qataris, Earth Capital, that own 10% of the stock. Every few months, they like to lob in a low-ball offer for the whole company, which bumps the stock up. First, it was $60 last summer.
I know, they brought it down.
Then it was $47.
They own, no,
And now it's 30?
10%
What
of
is
the
it?
stock and 10% of conservative podcasters, the Qataris.
Well, shoulda, woulda, coulda. The competition's
Bottom
over
line is
in
it's
2
time
weeks.
in the market.
We don't have a year to wait for this turnaround, Tom.
Oh my
Thank
good
you.
turnaround! Tom says
Now
we
this.
should take a year. Well, the cost, natural gas prices have been stable. So the wire side of the business, the distribution, the transmission costs are up between 70% to 300% over the last few years. And to your point, that's skewed towards those states that are Democratic led, and those are just the facts. So I think you need it to be better run, and I think a spotlight needs to be put on state by state, which ones have the highest costs and why, and break that down and let the people vote and see if they want to continue that. And I think the answer this October is going to be no, they don't.
And we're back. And then I had the great pleasure to join Diane King Hall. Want to thank Dan Mungrew and Diane for having me on. Listen in here.
Joining me now here at the big board to talk us through all the volatility is Tom Hayes, founder and managing member of Great Hill Capital. Tom, it's good to see you.
Great to be here.
Let's start out with where things stand from a macro perspective. We got a new tweet truth this morning with President Trump talking about basically they're going to pull back. They've had productive conversations with Iran, is what was said. There's been some pushback from Iran, but basically a lot of volatility. You said that similar to tariff volatility last year, this will start and end with a truth or tweet. Tell me more about that.
Well, I can tell you there are a lot of short sellers waking up this morning sending their applications to Walmart to become greeters.
Okay.
I mean, look, at the end of the day, this is very much like the tariff situation last year. Obviously, war is devastating. We're losing lives, so we weren't doing that with the tariffs. But it was started by a tweet, and it did end with a tweet, and it's similar to this situation. No one really cares if he spoke to Iran or not. What they care about is the fact that he tweeted this morning that he's de-escalating effectively and giving them 5 more days to negotiate. What I had planned on coming in and talking about this morning was mindset around investing. If you bought an apartment building 8 weeks ago and it was cash flowing and the rents were coming in, and someone came to you this week and said, Diane, energy prices are up, we might be going to World War III, you paid $1 million, I'm offering you $800,000. You would say to that person, are you out of your mind? My rents are still coming in. There's still free cash flow. Why would I ever consider that? And yet in public markets, people were doing it like nobody's business on Thursday and Friday of last week. We saw put skew, at the highest level since the COVID lows. You want to talk about uncertainty. We had no idea if we'd ever get a vaccine.
That's true.
We had no idea if
people would live.
If the world would reopen. And the amount of fear that was in the market and people buying insurance after the house was already on fire. If you're going to buy insurance, you do it when the sunshine is out, nothing's wrong, and everyone was selling in the hole. And we saw the sell volume on Friday hit levels not seen since the lows in October 2022 and the lows in March of 2020, COVID lows.
So do you think de-risking is a mistake?
De-risking is an excuse for not knowing what you own.
Okay.
Or a hedge against having paid multiples too high relative to the cash flow in the businesses. So why was it so easy to knock the stuffing out of software this year, which had nothing to do with tariffs? Is because price is what you pay, value is what you get. People paid ridiculous multiples on the assumption that the growth would never end. And now we know that the growth rates are going to end. They're not going to be completely disintermediated by AI, but they no longer have the same pricing power that warrants 40, 60, 80 times earnings multiples. So when you get a reduction of growth, when you're paying multiples that high, if growth goes down by 5% from 30 to 25, you don't get a 5% reduction in the stock. You get multiple re-rating, sometimes 20, 25, 30%, which takes the stock down 30, 40, and then you get forced structural selling. And on the other side of that, is the opportunity to benefit from dislocation, and that's where you make your money. So, you know, one of the things that we were doing, both in the tariffs and in this situation, was buying each red day. And what we would tell our audience, we have a podcast, we have our clients, we would say, look, we don't have a crystal ball. We don't know when this is going to end, but we do know that the price relative to the free cash flow in the companies we are buying is extremely attractive on an intermediate to long-term basis. And that's the only way you can really outperform in efficient markets.
So I feel like one of the things that seems to be at play is there is some FOMO on both sides. You know, right now it's the have we done too much and, you know, head to the exits like last week. Although, like, right now, obviously, we're indicating higher.
Yeah. Could change by tomorrow.
It could. I mean, if there's another tweet or a truth post.
Probably not, though. He's kind of indicated where his hand is at the moment, and he wouldn't put this out if he wasn't really going to dial it back.
Okay. So let's talk about opportunities, dislocation opportunities. There's a couple names on your list right now. VF Corp is one of those. Tell us what your view is on that and why you're constructive on it.
Yeah, so consumer discretionary is the most underweight since October of 2022. So if you're going to get bang for your buck on the recovery or a bounce back rally, it's going to be in consumer discretionary. Consumer sentiment is at multi-year lows. Everyone's in the gutter. No one thinks anything good is going to happen. But you have these tax refunds. So if this actually gets alleviated and gas prices come down, consumer discretionary is the most operating leverage to make money. So VF Corp, this is Vans, Timberland, North Face, Alta running shoes, JanSport, Eastpak. You have kids that go to school. They sold off Supreme, paid down debt. They sold off Dickies, paid down debt. Bracken Darrell is a turnaround specialist. His last turnaround was a company called Logitech. They make the webcams and the mice. Yep. He came into that stock when it was down 86%. If you invested $1 million when he started and sold it when he left, you made a 26 bagger trough to peak. 1 million became 26 million. He's doing the same thing with VF Corp. It won't be a 26 bagger, but we do believe from these levels, and it's come in a lot. No.
Okay.
3 bagger over the next 3 to 5 years, which is a very above market IRR. Very attractive. 10% of their portfolio was back to growth a year ago. 75% of their portfolio is back to growth today. They've deleveraged the balance sheet. Cash flows are coming back. They've taken $300 million of costs out of the business. Bet on Bracken. My nickname for him is Growth Bracken. He's going to turn this thing around.
I like that.
Yeah.
And last one on your list today is Disney.
Yes.
That must have been a tough one. There
Yeah.
are believers in Disney.
Yeah.
Do you see the magic returning to the Mouse House this year?
Happiest place on earth. What can I tell you? Look, Josh D'Amato, he ran the experiences business. It was a $36 billion business. It's the highest return on invested capital business in the Disney portfolio. This company used to be a parks company that owned media. Now it's a media company that owns parks, kind of thing. Record free cash flow last year. You wouldn't know it by the stock. They did $7 billion of buybacks. He's got a lot to work with. And the experience business alone at $10 billion of EBIT is worth $80 a share. You're getting ESPN, you're getting the films, you're getting Disney Plus for free, and Disney Plus is now free cash flow positive. So we like this story. We think it's the downside's protected, the upside could be meaningful over the next couple of years, and now we have some certainty around the leadership. That's a positive thing.
All right.
And we're back. And finally, I had the incredible interview with Ashley Mastronardi. Thanks for Mel Montanez and Ashley for having me on. We'll listen in here.
But we begin with the markets, as we often do here on NYSE Live. Joining me now is Tom Hayes, chairman and managing member at Great Hill Capital. Tom, welcome to the New York Stock Exchange.
Thanks for having me, Ashley.
All right, so we've seen a lot of choppiness in the markets. We're hearing maybe there will be an end to the war. Now, this news just came out, Iran saying they're not agreeing to a ceasefire. How do you think the markets will react?
Well, you can't make this stuff up. Listen, we are set up for a rip your face off rally. That's exactly what's happening. And how do we know that? Well, there's a couple things. First and foremost, by the way, the Iranians said they weren't talking over the weekend. The New York Times reported that they were talking over the weekend. So that's immaterial. What matters is that Donald Trump decided to de-escalate on Monday. And that's all the market really cares about. We've had 30 of these geopolitical events since 1939. after they start, they tend to bottom on average on the 15th trading day, which was Friday, ironically, and they tend to recover most of their losses within a few weeks after, even before the fighting stops. The expectation of the fighting stop, the expectation of the resolution, the market starts to discount that future, and we're seeing it in a strong open market. We're seeing it in a strong last few days, and I think we're going to continue to see that.
So are you saying when these geopolitical events happen, there is initial volatility, initial choppiness, and then historically we see things even out?
That's correct. As a matter of fact, if you go back to post-World War II, there's a saying, buy the bombs, because 12 months later, the S&P is up 12.93% on average. This is the cost of doing business. This is normal volatility. In any average year, you get on average 3.55% pullbacks every single year. You get on average 10% pullback every 11 months, and you get a big 20% pullback every 3.5 years. We've actually had 20% pullbacks in the last 6 years, so I think a lot of that's pulled forward. In the background, the things that people haven't been paying attention to is, while all this noise has been going on, and private credit and the war and all this stuff, earnings estimates have actually been going up. Okay, now they wouldn't continue to go up in perpetuity if there wasn't some type of resolution this week or next week, which now we're seeing moving in that direction. But the underlying economy is strong. Even GDP now is over 2%. So if they can kind of put a bow on this and show some path to resolution, I think that the market wants to go higher. And the other thing that's so critical, Ashley, never buy insurance after the house is already on fire. You want to buy your insurance before. And last week in the hole, we had record put buying, record selling volume that we haven't seen in years. We haven't seen since the 2022 lows and since the COVID lows. The exact wrong action at the exact wrong time, emotional behavior, when great businesses were on sale like we've never seen before, and great businesses still are on sale, but people will be too scared. They'll wait till the market makes new highs, and that's when they'll get in, and that's when you get a pullback. And that's just the way it's always been, and that's the way it's always going to be.
How should the average investor manage geopolitical uncertainty in the markets?
This is the most important thing, okay? And I have a podcast that I talk to people about. If you bought an apartment building 2 months ago for $10 million before the war started, okay? The tenants are all paying rent. The war starts, oil prices go up, the market goes down, and someone says, Ashley, we could have World War III. I'm going to offer you $8 million for your apartment. You're going to say, are you crazy? I just paid $10 million for this. The rents are still coming in. The free cash flow is still coming in. And you're low bidding me at 20% off. Why would I ever do that? And yet people do it every single day in the stock market. They get seduced by the negative headlines, and they forget the fact that if they've bought a good business at a reasonable price that's still generating positive free cash flow, just because there's a war going on in Iran doesn't mean you're going to drink, 2 less Diet Cokes, or, I drink Diet Coke. You're going to still do your regular activities. Now, if it persisted for a long time, obviously elevated energy costs have an impact on margins on different businesses over time, and you have to start to factor that in. But in the short term, you would never take that 20% off bid on your apartments. Why would you take it in high quality stocks? And furthermore, if you saw an apartment building that was selling for $10 million before the war started, that now you could buy for $8 million, would you be buying it? And the answer is yes. The cash flow is still the same. I can get it at 20% off. And those were the opportunities last week, and those are the opportunities this week if we get hopefully a little bit of volatility into the weekend to enable people to buy some good quality stocks.
And I understand you say the volatility we're seeing now because of this conflict in the Middle East is similar to the tariff volatility we saw last year. Can you expand on that?
Yeah, very simple. Started with a tweet, ends with a tweet. I mean, this was kind of man-made manufactured, and it was man-made resolved. And that was one of the generational opportunities to buy stocks last April. Yes, you had to look at what companies would it impact margins, but at the end of the day, they all got passed through for the most part. And in terms of oil, we had many years in the Obama administration with oil prices between 90 and 100, and the market recovered just fine.
And I understand you say that when ships start moving through the Strait of Hormuz or the war is declared over, that investors are going to get the most bang for their buck. Can you speak into that?
Yeah, so we saw 8 ships go through the strait yesterday. They're allowing, non-U.S., non-Israeli linked ships to go through. The Iranian ships are getting through. They've released the strategic reserves all over the world. So I think what people need to do is step back and say, can I buy? The people who are really worried and the people that were really impacted by this pullback were those people that paid too high a price for the earnings that they were getting. People chasing the shiny objects, the Momo stocks that were trading at 40, 60, 80 times, because when those correct, they may never recover to an 80 times multiple. But if you were buying good businesses at reasonable prices, you were unfazed by this. And if you were smart, you bought more. And I think that's going to be the opportunity, hopefully in coming days, that you can get a few more shares.
Anything else you are looking at right now that you think we might be hearing about in the next few months?
I would be paying attention to consumer discretionary, because consumer discretionary is the most underweight sector, according to Institutional Managers Bank of America Fund Manager Survey, which you know well, since the October 2022 lows, okay? So right now, consumer sentiment is in the tank. People are worried about the war. When this gets resolved, consumer sentiment is going to rip higher along with the markets, and the tax refunds are 10% higher than they were last year. They're going to put that money to work, and that's a group that has been left for dead that you can make a lot of money doing.
All right, Tom Hayes, managing member at Great Hill Capital. Thank you so much for joining us at the New York Stock Exchange.
Thanks for having me, Ashley.
And we're back. And want to thank Luca Blauman for including me in his article on StocksPo about Dentsply, VF Corp, and PayPal. And now on to our quotes of the week. Charlie Munger, the world is full of foolish gamblers. They will not do as well as the patient investors or well at all. Buffett, today people hold cash equivalents and feel comfortable. They should not. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. He should take his own advice of late, but I understand why he's handing off with all of that cash in case there is a sell-off after he passes. It will enable Greg to buy in a lot of stock and get them off on some stable footing, as well as all of the insurance exposure that they may or may not have that require them to post that type of cash and reserves against the obligations. So don't be misled exclusively thinking Buffett is bearish or bullish at certain points, because if you look back through history, there is a very low correlation between the periods in which he holds high cash and the periods in which the market goes down. It's more often tied to insurance obligations, etc. Want to thank all the people who have been supporting and spreading the word of the podcast. We do this free every week for clients and non-clients alike. We want to keep that going. And the way we keep that going is the best thing you can do. The people who are clients, who are not able to become clients, is share it with one person you care about that would benefit from this content every single week. And a lot of you have been doing that through wearing the merch, the hats, the mugs, the t-shirts, the hoodies. Are my favorite. And then people ask you and send in a picture to info@hedgefundtips.com so we can get you up on the website and you can show off your swag like all these incredible supporters that have helped this grow to over 60,000 subscribers on YouTube and growing. So we keep doing this and we love it and we thank you for your support. All right, let's get down to data. A lot of great stuff today. First and foremost, I referenced this chart in a couple of the interviews that there have been 30 major geopolitical events since 1939. As events in the Middle East get more worrying, we are approaching the usual bottom in terms of timing. Will this be the same time or different? So the average is about 15 trading days in, which was give or take on Friday. And then the market has a tendency to recover most of those losses even before the shots discontinue firing. In other words, the expectation of resolution is more important than the resolution itself. This blew my mind. My friend Paul sent this over today. Stifel put out a note upgrading Cooper Standard with a $61 price target on Cooper Standard. They hosted Jeff Edwards and John Banas and Roger Hendrickson for investor meetings in Boston this week, and they came away with incredible confidence, from new business wins to gaining share in growth markets, etc. So I want to read some of these things as it relates to implications from the Iran war. The bad news is that increased oil prices leads to annual input cost increase of 400 to 450,000, but this net exposure is expected to be negligible with contracts containing escalators and de-escalators for raw material price changes. It's not 2008 anymore. So they fixed that problem. So there is a quarter lag, so it could have a negative impact on 2Q 2026 before a recovery in the second half. So that, the stock market is kind of sniffing that out as we speak with the recent weakness. Market mix shifts provide structural growth tailwinds. We've talked about this many times. The financial metrics, return on invested capital was 7% in 2025. Management believes and gets paid on tripling return on invested capital in 3 years. Long-term incentive plans start paying out at 10.5% return on invested capital, with maximum payout coming if the company achieves tripling return on invested capital over 3 years. So guess what they're going to do? Is show me the incentive and I'll show you the outcome. Thinking about M&A, that's a really interesting thing now that they're free cash flow positive and building strength. There are a lot of smaller subscale players that they can get involved in. This was the short volume that I was referencing in a couple of my interviews. You can see here when you get this kind of high volume selling, it tends to be right at short-term bottoms. And while everyone is debating about some small island in the middle in Iran near the Strait of Hormuz and game theory and all this nonsense, rather than just paying attention to cash flows of good businesses and buying them at good multiples and pretending they have some geopolitical edge and wasting everyone's time, we just look for good companies at great prices and rinse and repeat. And if you're not buying on red days, not predicting the bottom, not calling the bottom, but just looking at the odds based on how people are positioned and the incentives of all the actors, namely with the election coming in November, with consumer sentiment, with all these things happening, what is the likely outcome, and what do we know about the administration's behavior in similar situations when there's market pressure? And we saw the first taste of that Monday and talked about it extensively on media. Emerging markets versus developed markets, relative forward price to earnings, that's still the bargain. We talked about that a lot last week. Financials still neglected by active fund managers. We're playing that through PayPal. That's our duel. What's been hurt is financials on the private credit fears, which are real but overblown. It affects 8 some odd percent. And I read all this alarmist stuff over the weekend, and this is 2008 and this is CDOs and blah blah blah, and all the arguments had tremendous holes in it, and it was a bunch of sensationalist stuff. And oh, by the way, they charge you $24 a month for their letter, and they've never made any money managing money. But other than that, they have all the answers. So financials, and so we get the best of both worlds. Software's been hit, financials been hit. When this thing turns, both of those are going to get a bid. We get 2 bites at the apple with PayPal, which we love. Bullish, by the way, while you're at hedgefundtips.com ordering your hats and your hoodies, click on terms. This is all opinion, not advice. Consult your financial advisor before doing anything. Bullish growth expectations imply PMI expansion. So that was a key indicator that we've been talking about for many months. That has moved into expansion. Historic concentration peaks. We've talked about this. and why we had been telling people to avoid the Mag 7, and all of them are negative. All of them are dramatically underperforming this year and last year, by the way. And you can see going back to 2000, going back to 1998, going back to the Nifty 50s, when you get at this level of concentration, you always get a new group that comes in and those start to fade out. And it's very hard for them to stay at the top. It's not to say they won't bounce hard. I know Stu said, Tom's buying tech. That wasn't in my notes, but I go with the flow. We did buy, actually, for the first time in a very long time, because we had new clients, new money to put to work. We bought some BABA at 125. Yes, our basis is 82, but down at these levels with the Trump meeting coming up in May and all the things that they're doing with chips and AI, still the cheapest AI play in the world. So that's how we're expressing our tech. And obviously our software/financial through PayPal. We still own half of our Intel position. We took off half after it went from 20 to 53. And kept the other half. I think Lip Bhutan's going to deliver amazing stuff with that. Okay, next. This is the thing that the administration has to worry about, is the share of wallet allocated to energy costs. That's becoming a real issue. Private sector deleveraging continues, debt as a percentage of GDP. That's why I do think this private credit thing is a little overblown. I was one of the early warning people about the facade of private equity and private credit with their mark to make believe, and when you get a mark, it's going to be a mark to zero. So we're seeing that right now. I think that this can is going to get kicked down the road. There's going to be some resolution with Iran that's going to take some pressure off inflation expectations. Warsh will get in, they will be cutting, and these bad loans are going to be refinanced, and it will become a major problem years down the road, but just not yet. The retail people will get out. The institutional people will probably try to stay in because they don't like volatility in their portfolio. They would rather have fake marks than daily marks, so they get to keep their jobs until the marks go to zero, and that game will keep continue. That's the real. It's not private equity and private credit. It's not like they're buying businesses that get a higher return on capital than the ones in the public markets. If anything, the opposite is true. The difference is they get to mark them at whatever they want and charge a 2% management fee, whether they do well or not, and then a carry on whatever they market to, and then they sell it to another fund at an inflated value and buy something inflated from the other fund. And it's just a game of musical chairs that will eventually end poorly. But in the meantime, while the music is playing, they continue to dance. I don't think that reckoning in a material way is going to be this year. I do think there is going to be a material reckoning as some of the maturity walls come down the road. Corporate cash flows are covering CapEx, with the exception of Mag 7, that they're now close to 90% of operating cash flows going to CapEx, which is why even when they bounce, I think that bounce and short-term relief rally from Iran should be probably faded into the fall, and I think there'll be some good bargains there later in the year in that group. National Association of Active Investment Managers are basically out of equities, so as this thing rallies, they're going to be forced back in panic buying. I don't know what the resolution is looking like, but I will say the setup looks like it always looks like right before you get a positive resolution. So whether that's boots on the ground and they take Karg Island quickly over the weekend, or the Iranians buckle and say, once they take Karg Island, we have zero negotiating leverage. Let's throw them a bone and say we want to talk and we'll give them XYZ, and then lie and do whatever we want and be back in the situation in 5 years. Historical retail sales and forecast going up. That's positive. Higher oil prices, less shocking than in the past. The impact of a 1% deterioration in terms of GDP growth. We are now energy independent, so the impact on GDP is less material for us and devastating for Europe. As you can see, during all of this, estimates have still been going up. We're expected 12% earnings growth in the first quarter, 15% into next year. Those will come down if this stays prolonged for the next few months. But if it's done in the next few days or the next few weeks, or at least expectation of resolution is done, I think these estimates are going to stay high. The economy is pretty darn strong still, and you're not going to get a recession with GDP at 2%. That can change abruptly, but it hasn't changed yet. Okay. Volatility is the toll we pay to invest. This is from Ryan Dietrich over at Carson. We referenced this on one of our hits. You get a 5% correction 3.4 times a year. You get a 10% correction every 13 months. You get a 20% correction every 3.5 years, and you get a 15% correction every 2 years. We've had 20% corrections in the last 6 years. I think we've pulled forward a lot of those. I would be surprised if we got a 20% correction this year. I would expect later in the year, after a relief rally in coming weeks and months, potentially a low teens pullback into the election, because there'll be a lot of uncertainty around that. And I think the other thing that I'm keeping an eye on that really virtually no one else is a European debt crisis issue again, like 2008. I'm watching Italian bond yields. I'm watching the demand on spending. I'm watching their growth. So something to keep an eye. While everyone focuses on private credit, I think the real issue is going to be public credit and in Europe, and that probably creates some of that volatility later in the year. Non-financial debt burden continues to fall. So again, personal balance sheets have been delevered. Business balance sheets have been delevered. So yeah, there will be idiosyncratic things, and that's how the narrative will change after the stock market goes up, because opinion follows trend. It will go from all private credit is bad to, oh, this was just a few instances, tricolor, and some bad underwriting, and that'll be the bad underwriters, not the good underwriters, and there'll be a relief rally in all the banking and probably some of the private equity stocks, which we're not going to play, by the way, on that side. Traders turned bullish for the dollar first time in 2026, so that will be a counter trend rally. The trend is down over the next few years. Biggest long only selling on record. That's a contrarian buy. All right, what else do we have here? Vehicle affordability index continues to drop. Don't forget you have deductibility of interest payments for US made cars. That's a big deal. Home price growth has been slowing. Again, more affordability coming to a theater near you. Gap between ARMs and fixed rate mortgages is near a 4-year high. You can get an ARM for 5.07. 30-year fixed rate. This is that was as of March. The fix was at 6.19 and the ARM was at 5.51. Earnings growth, a friendly reminder, if you price is what you pay, value is what you get. The multiples are the lowest for the small caps, with the earnings growth expected to be the highest. S&P 500 earnings growth, according to this chart, 17%. We have it at 15.7, but good enough for government work. Russell 2000, on the other hand, this year 48%, next year 30%. Multiple is about 25% lower. Here's a similar chart about the timing of these type of events. New cycle has begun. This shows U.S. versus international. Let's see, ratio in the chart above divides the emerging markets price index by the world price index. When the ratio rises, emerging markets outperform developed markets. That is in the early stages. We have exposure through China. We think that's going to be the biggest bang for the buck as those weights go back to normalized levels and they execute on all cylinders. And that, I think the May meeting is going to be a core catalyst in that ascension. Okay, we've got PE versus S&P. That's percentile rank versus history. So what they're showing here is the relative PE for financials is very low relative to history. Same with healthcare. Utilities is very high relative to history. Industrials is very high. Consumer discretionary is very low. REITs are very low. Materials are very low. So that's where you can be shopping in this time of opportunity. Okay, we've got discretionary equity positioning. CNN fear and greed got down to the mid-teens. Historically, that is the time to be a buyer, not a seller. Midterm years can be a pause. You tend to rally into late April, early May, and then weakness into the election, and then an end-of-year positive resolution. Here's healthcare stocks above their 50-day emerging market exponential moving average. When it gets this low to the 10 or lower, you tend to see short-term or very near short-term bottoms for the healthcare sector and opportunities to buy healthcare. We agree. We continue to shop in those areas. You can see what's happened to earnings estimates since the Iran conflict began. They've continued to go straight up. That won't happen forever if this drags on, but it is happening now. Cheapest valuation in years. This is tech next 12 months PE ratio relative to S&P 500 next 12 month PE, and you can see there are some bargains to be gained there. Average tax refund is up to $3,623 from $3,271 last year and $3,109 the year before. So hopefully that doesn't all have to go into the gas tank. Hopefully some of it will go into restaurants and consumer discretionary. That just depends on the timing of the resolution. Let's see. Retail trading activity has gotten knocked down. Very interesting, very similar to 2022 lows. They've kind of given up, and that's when things tend to turn. MSCI energy in the all world country index is now turning up. The weighting has dropped from 14% down to a trough of 3%, and it's now picking back up. So pay attention for that. Any pullbacks, I think right after the resolution of this Iranian situation, a lot of the energy stocks are going to sell off. That'll be an opportunity to buy or add into the group for the long term. M2 money supply 1 year change. We talked about the Fed liquidity that's going on in the background last week, and you can see that reflected in M2 money supply picking up after getting absolutely decimated in 2022. We got a lot of data this week. All right. S&P moving sideways. This is what I was talking about last week with Stu. I said the S&P, the only thing that's stagnant, he was asking about stagflation. The only thing that's stagnant is the price of the S&P 500 for the last 6 months. It's basically done nothing since September. It's now at the bottom of the range. Let's see if it can bounce. And I think potentially make new highs before rolling over into the fall. But we'll take it as it comes. Short interest on the Russell 2000. We've talked about this chart. Breakout, back test, and resolve higher. You can see the short interest at levels when you tend to get big bounces, and it's the highest since April 2025, which was the time during Liberation Day sell-off to be buying small caps like crazy. I think this time is no different. Historic foreign investor sell-off in Asian emerging markets. Again, this is like the pandemic. If you bought it, you got paid. If you bought during the Ukrainian war in 2022, you got paid. By the way, that war is still going, and the market moves on. The same will be the case with the Iranian situation once the strait is open. You could see bombing and fighting for the next 10 years, and I'm not belittling that. That's a devastating loss of life that's probably unnecessary and doesn't need to happen. But the market will look past that once the ships are getting through. Okay, and that's that. Now, the Slumer stuff. Let's just keep things here in perspective. This is, again, the roadmap for the red line is what year 2 should look like. Again, that's weakness into kind of where we are now. Huge strength in April into early May, and then weakness into the election before resolving higher before year end. So basically, you could just go on vacation, come back in January, and it would be like nothing happened. This shows you some of the longer term charts. You can see the S&P 500 daily retesting these lows. Let's see if we get the bounce. Equal weight, same story. NASDAQ, same story. These all look like they want to bounce. Russell, breakout, retest, move higher, and so on. So a lot of good stuff here. Hang Seng, similar story. Government yields bumping up against the top end of the range on the 30-year and 10-year. Little breakout. Do we have to go up to 449? We shall see. That's the next level of resistance. But my sense is we're probably going to find some resolution to the downside in relatively short order. And I think this weekend is going to be critical. So probably a little volatility today and tomorrow into the weekend because no one knows what's going to happen with the Marines headed over there. They're probably not going for a beach vacation. They're going to make the world a lot safer if they can completely eradicate the ability of Iran to ever have a nuclear weapon. But we shall see. There seem to be efforts to mitigate that possibility diplomatically after a huge military pounding, but we'll see how that resolves. Zooming out on the dollar index, you could see here, downtrend, counter trend rally, up against resistance, probably resumes the downtrend in coming weeks and months. This is what it looks like here. We need to see a break of this trend line. Maybe you get a retest back to 100, but more likely than not, this starts to break down. That helps emerging markets. It helps small caps. It helps everything. The loonie, still strong relative to the dollar, going to continue to move higher in coming years. Same with the euro. Here is energy. Broke that uptrend, probably works its way back down over the coming couple of months. Very unpopular opinion, but we'll see. Gold seems to have hit its short-term target. It's down from 5,500. I think it got down to 4,200. Maybe it's 4,500. Wow, got down to 4,100. So there you go. Same thing with silver. Happens every cycle. People are surprised. I don't understand why, but the most surprised ones are the ones who bought up at 5,000. Oracle, these type stocks are probably going to bounce off this next move higher. Apple, Nvidia, let's see. Micron, same story every cycle. They get demand. Memory is a shortage. They build factories. Everyone builds factories at the same time. By the time the factories are done, demand has diminished, and you get a huge glut. So whether we're there now, they're building the factories. Maybe they get a little bit more boom, but I wouldn't be a buyer at these levels. Just put it that way. Even if you get a short-term pop, 2 years from now, I have a pretty good idea where that stock's going to be. Schlumberger Oil Services breaking out. We've got that exposure through National Oil Well Varco. Financials have come down here a little bit. Nothing material. Wells, interesting. KKR. Some of these are going to bounce hard. I wouldn't be chasing these that have had these big runs up, though, that's for sure, on the war. Okay, so that's that. Let's look at some of these technical indicators, the barometers that we use just to get a feel when the market's not trading on fundamentals. It's trading on emotions based on headlines, which you can't really guard against. You can't predict. Anyone that says that they can, they're just wasting your time and money. you're just using these periods in a year where you get the normal 5 and 10 and 15 and 20% pullbacks over those time intervals we talked about to buy good businesses at great prices, or to add to good businesses that you own at great prices. Because if you're not buying on red periods like this during periods of dislocation when there are forced sellers and margin clerks creating opportunity for you, very hard to outperform. So this is like when it rains gold, pull out the bucket, not the thimble, as the great Warren Buffett said. This is one of those examples. So here's the 10-day put call. When you get this aggressive, these are near major lows. Okay, you can see some of these indicators have been flushed out. NASDAQ 1% EMA, advanced decline ratio. This is usually where you get massive bounces. Doesn't mean it can't go lower. It's just the odds start to favor you. NASDAQ Cohen high low. NASDAQ up, down on balance volume. Here's real estate. Stocks above the 200-day emerging exponential moving average. Same with materials, a little bit flushed out. Same, certainly with healthcare, flushed out. That's where you want to be buyers, not sellers. S&P mid-cap intermediate term volume momentum oscillator. McClellan summation index. Again, these are at or near levels where it pays you historically to be a buyer. Dow Jones Industrial Average, percent on PMO crossover buy signals. It's all noise. You just look at when this thing gets stretched out, what tends to happen in the market. And what tends to happen in the market is you're at or near a short-term bottom. And it's across the board. S&P 500 bullish percent index, that's a point and figure thing. We could care less. But what we know is when it gets down to these levels, you generally are rewarded for buying stocks. That's why we say on red days, you want to be nibbling or buying or adding to good positions, good businesses, cash flowing business. The only people that are screwed here are the people who bought stocks at 80 times earnings at 3 times PEGs, price to earnings growth ratios, and those multiples are never coming back. So when the stock market rallies, they'll get a bounce, but they're not going to get a rally back up to an 80 times multiple because they've been completely re-rated in terms of their business moat. And that's why we've historically avoided software, because once the moat is eroded, the multiple never goes back. Even if the growth slows modestly, the stock can't recover. And you're seeing that over and over. So McClellan summation index. That's why we buy software stocks like PayPal when they're trading at 8 times with a 17% free cash flow yield, buying in 15%. Because if anything goes, it's already priced in everything that could go wrong. If anything actually goes right, like the ad business we've been talking about, which is $1.5 billion to $2 billion of free cash flow that no one has in their models. Like the margins have been turning up, like the new CEO buying in more stock, like all of those things happening. And Venmo, by the way, now in 70 countries, which they just announced this week, and the growth of their stablecoin, and the 20% growth of Venmo, and the 20% growth of buy now, pay later, et cetera, which I don't love that business, by the way, the buy now, pay later, but it's a growth story within the thing. That'll be a problem down the road. We'll deal with it then. So McClellan oscillator turning up. Same thing on the NYSE, McClellan summation. Wow, this got flushed out here. This was the NYSE advanced decline volume. So we just keep an eye on these things, and they tell us when the odds favor us being buyers versus sellers, and that's been the case. It was most pronounced last week when we said that. You got another weekday, and then Trump de-escalated aggressively on Monday, and we've been grinding higher, and those lows were put in on Friday have stayed, and that's been positive. Some key headlines here. Alibaba stock jumps. China food delivery war just took an unexpected twist. The government said, we're not going to allow you to continue to destroy your margins. We want you guys to be profitable and successful. So they stepped in. That's a good thing. Alibaba workforce shrinks 34% in 2025 as Chinese tech giant doubles down on AI. Alibaba chairman Joe Tsai credits China's AI edge to power grid and open source models. Alibaba unveils new chip design to meet surging demand for AI. Their new chip for agentic AI and inference computing, adding to a portfolio of semiconductors designed to drive its artificial intelligence ambitions. I said years ago on this podcast when Biden was restricting chip movement to China. This is the dumbest thing that we could ever do because we have taken them from being dependent on us to be forcing them to be independent. And this is what happened. The Trump administration followed through, did the exact same thing as the Biden administration. And this is the end result. Good for Alibaba holders, bad for the U.S. AI boom accelerates China's chip industry growth as demand strains supply chain. Trump to travel to China on May 14th to 15th for a summit with Xi. Trump tells aides he wants speedy end to Iran war. His odds of holding the House and Senate have collapsed in recent weeks with the Iran war and consumer sentiment where it is. He could quickly reverse with a quick perceived or actual win in Iran and get things back to normal and get the economy booming. But he's on the skinny branches at this point. I think he knows it, and that should bode well for a short-term resolution and possibly help him in the fall. But we're getting close, and these things don't snap back overnight. Forget the war headlines. Market fundamentals will win the long game, these strategists say. That's what we talk about every single week. Morgan Stanley's Wilson sees S&P profit boom despite Iran war. Yeah, that's correct. Estimates have been going up, but the war needs some type of wind down. Citadel Securities, Rubner sees short squeeze fueling U.S. stocks rally, and it's early days, by the way. You had record put buying like you haven't seen since the COVID lows. Buying insurance after the house is on fire is the dumbest idea. Like starting to hedge after a correction has already begun is like the dumbest, most expensive idea, a guaranteed way to lose money. You just have to ride these things out and be looking what to buy, not how to hedge after you've already missed it. And those people that are always hedged because they're always expecting a black swan, they just keep giving money to the casino. The casino happily obliges. It's a bad framework is what I'm saying. So next is Bernstein sees 1970s style super cycle for Middle East oil services. That's why we have Varco. U.S. gas exporters stand to be the big winners of the energy crisis. That's why we have Comstock. Speaking of Comstock, they announced the selection of Western Haynesville site to host power generation hub. Recently announced Texas natural gas-fired power generation hub in Anderson County, Texas. Venezuela opposition leader vows to fully privatize oil. Intel stock is climbing. Why the company's new chip launch is so significant. Launch of enterprise-focused processor shows it's ready to ship high volumes of products made with its new chip technology. Built on advanced process technology, signaling the semiconductor maker's faith in its manufacturing efforts. So that was their free option on the next $50 in the stock. We're excited to see Lip Bhutan is executing. Why the chip maker is making pricing updates. PC manufacturers face a CPU supply crunch leading to 10 to 15% price hikes and planned increases from Intel and AMD. Intel stock jumped 7.3%. Driven by positive signals regarding CPU pricing and demand, etc. So we love that. Diageo sold its cricket team to a Blackstone-backed consortium for $1.8 billion. That's a non-core asset. We like that. Estee Lauder in talks to acquire Spain's Puig to create global beauty giant. Short term, they never like the acquirer stock never likes it. Long term, there might be some synergies, or they may not do it. We'll take it as it comes. But one step at a time. Peak pessimism towards consumer stocks flashes a buy signal. We agree. Consumer discretionary is going to be the biggest bang for the buck in the next rally. Weight loss drugs are changing the way people dress. These companies stand to benefit. So they've got Lulu, Nike, and VF Corp would fall into that group because they've got to change out their wardrobes of North Face and etc. Spam makes a comeback as pinched shoppers embrace the cheap canned meat. Hormel, baby. Domestically, the brand has achieved record net sales in 9 of the last 10 years, steadily growing its fan base in the United States. This decade of growth is evidence that new on-trend flavors and the brand's accessibility and versatility in the kitchen are connecting with today's consumer in exciting and fun ways. So, my kids eat Spam. This Masubi stuff, like at the swim meets, they have these it's like fake sushi. Instead of fish, there's meat, rice, and seaweed, and it's a huge thing out here on the West Coast. And it's obviously Hawaii is Spam central. They love Spam in Hawaii. So there's Hormel Foods. Pfizer, Valneva reports strong efficacy data from Lyme vaccine trial coming from Connecticut. That would be amazing if they had a Lyme vaccine. Advanced auto parts supply chain transformation leads the turnaround. Shane O'Kelly is hitting on all cylinders there. We continue to like that story and own it. Banks ready to put billions to work after regulatory win. Large lenders sitting on some $175 billion of excess capital plan to fund more loans, chase deals, and increase buybacks. Proposed regulatory rules would lower the amount of capital banks must hold, potentially freeing billions for loans, investment, and deals. Credit expansion is the key for every growth period. Private credit's zero loss fantasy is coming to an end as defaults and fund exits rise. Yeah, I think this is overblown in the short term. I think it's going to be a big deal in the long term. The Kingdom in the Cloud stock market and sentiment results. This week we covered Alibaba and Disney. Here you can read our kind of original thesis and core points on the position. For those of you who've been around, you know that it's been incredible buying all through these periods. Got our basis down to $82, and then it took off to $192. We made 7x on the option spreads, kept 100% of the stock. We've rode this pullback. We're now adding some here for new clients, and we think the next leg is around the corner. So we covered all. I would revisit the original thesis here, core points from that. The earnings, we can talk about that. 10th consecutive quarter of triple-digit AI revenues, by the way. And here are the 10 key points. Revenue came in at $40.73 billion, up 2% year on year, plus 9% ex disposed businesses, SunArt and InTime, missing consensus by $1 and $1.42 billion, adjusted EPS of $1.01, missed by 58 cents, with the weakness driven by intentional decision to reinvest heavily into quick commerce and AI cloud infrastructure. While the headline numbers may look ugly, we continue to see it as mostly noise. The underlying business is on a like-for-like basis, grew 9%, and the investment cycle is exactly what a long-term shareholder should want to see. 2, cloud revenue accelerated to up 36% year on year, a 4-year high, to $6.19 billion, with internal customer revenue accelerating to up 35% from up 29% last quarter. Adjusted EBITDA grew 25% to $559 million, with margins holding steady at 9%, with significant expansion expected as recently implemented price hikes of up to 34% begin to flow through. Alibaba remains China's #1 full-stack cloud provider with 36% market share, a position that has grown for 3 consecutive quarters, with the lead continuing to widen. Management expects to continue acceleration ahead, targeting the combined cloud and AI business to surpass $100 billion in annual external revenue over the next 5 years, a quintupling of the current levels, implying a 40% CAGR. Think AWS for Amazon from 2016 to 2022. 3, AI-related product revenue posted triple-digit growth for the 10th consecutive quarter, now accounting for a significant share of cloud segment. External revenue up 20% as of Q2. The consumer-facing Qwen app has surpassed 300 million monthly active users across all platforms, with deep integration across the core Alibaba ecosystem, including Taobao, Tmall, Amap, Fliggy, and Alipay. By the end of February, 140 million users had their first AI-driven shopping experience through Qwen's agentic features, with Qwen becoming China's first all-in-one personal AI assistant. Qwen models have also surpassed 1 billion cumulative downloads on Hugging Face, making them the world's most used open-source model family. 4, T-Head, Alibaba's proprietary GPU chip subsidiary, has scaled to mass production, shipping 470,000 AI chips, with annualized revenue now in the RMB 10 billion scale, 1.4 billion US. More than 60% of chips are serving and supporting AI workloads for 400 plus external enterprise customers across multiple industries, with management expecting continued production capacity expansion to meet demand. Management ranks T-Head in the top tier of the domestic AI chip ecosystem, with a clear edge in cost effectiveness relative to foreign counterparts. Management did not rule out a rumored IPO of the business, though no timeline was given. 5. China e-commerce revenue came in at 22.79 billion, up 6% year on year, with the core business ex quick commerce and wholesale at 18.82 billion, up 1% year on year. Customer revenue management revenue slowed to just 1% year on year to 14.68 billion, driven by softer transaction activity and the phasing out of the software service fee implementation tailwind from last year. 88 VIP members, Alibaba's highest spending cohort and equivalent of Amazon Prime, continued to grow double digits year on year and have now surpassed 59 million heading into March quarter. Management noted improved consumer sentiment, with both physical goods, gross merchandise value, and CMR trends significantly recovering, and EBITDA expected to improve accordingly. 6. Quick commerce revenue grew up 56% year on year to 2.98 billion, with continued gross merchandise value share gains and sequential improvement in both unit economics and average order value throughout the quarter. Management expects further UE improvement in coming quarters, driven by fulfillment, logistics efficiency, order mix optimization, and strong customer retention. Importantly, quick commerce strength is driving clear synergies with traditional e-commerce growth, with the Taobao app achieving double-digit year-on-year increase in MAA during the quarter. The long-term target of reaching 1 trillion RMB, or 138 billion in gross merchandise gross merchandise by fiscal year 28 as a market leader, remains intact, with management expecting positive cash flow upon hitting that milestone in profitability in fiscal year 29. 7. Profitability remained under pressure, with adjusted EBITDA down 57% year on year to 3.35 billion and margins falling to 8% from 20% in the prior year period. Increased investment in quick commerce continues to be a short-term drag, with sales and marketing expenses as a percentage of revenue climbing to 24.9% from 15% last year. On the positive side, G&A expense has declined to 2.5 from 3.5. Management expects adjusted EBITDA to continue to fluctuate in the near term as investments remain elevated amid intense competition. 8. Free cash flow inflected to positive to 1.62 billion after 2 consecutive quarters of outflows, even while reinvesting aggressively in AI, cloud, and quick commerce. While free cash flow is still down 71% year on year, and year-to-date outflow stands at 4.18 billion, the turn to positive is an encouraging sign, with the fortress balance sheet giving us plenty of comfort with the heavy investment cycle. 9. Alibaba's balance sheet remains in great shape, with cash and liquid investments of 80 billion and a net cash position of 42.5 billion, representing 14% of the company's total market cap. Excluding debt maturities beyond 5 years, the net position stands north of 60 billion. 10. Alibaba International AIDC revenue grew 4% year on year to 5.61 billion, with international retail up 3% to 4.63 billion and wholesale up 10% to 980 million. The segment continued to see losses narrow, with adjusted EBITDA loss coming in at just 288 million, driven by logistics optimization, investment efficiency, and improving unit economics in the AliExpress Choice business. Management expects further profitability improvement going forward. Now on to Disney. Here's the original thesis. You can go through these key points. The earnings call highlights. We starred and circled the most important points. You can read it at hedgefundtips.com. And the 10 key points. Revenue came in at 25.98 billion, up 5% year on year, beating consensus of 25.74 billion. Adjusted EPS of 1.63, beat consensus of 1.57, with the year-on-year decline reflecting lower entertainment results driven by film slate comps. 2. Streaming posted another strong quarter, with revenue up 11% year-on-year to 5.35 billion and operating income up 72% year-on-year to 450 million, well ahead of street estimates and prior guidance of 375 million, with margins reaching 8.4% versus 5.4% in the prior year. Strength during the quarter was driven by a 13% increase in subscription fees to 4.42 billion and 4% growth in advertising and other revenue to 922 million. Q2 operating income is guided to $500 million, up $200 million year on year, with management reiterating confidence in hitting 10% SVOD margins for the full year as streaming continues to take the baton from linear networks as Disney's next growth engine. Management also expects to roll out an integrated app experience combining Disney Plus and Hulu before year end, with the bundling strategy continuing to reduce the churn and drive engagement. 3. Disney's film studios delivered a landmark year in calendar 25, generating $6.5 billion at the global box office, making the third biggest year ever and the 9th time in the last decade Disney has ranked number 1. 3 films crossed the billion-dollar threshold, led by Zootopia 2 at $1.8 billion, which set the record as Hollywood's highest-grossing animated film ever and ranks among the top 10 highest-grossing films of all time. To date, Disney holds 37 of the 60 films in industry history to cross $1 billion, 4 times any other studio. The upcoming slate is as strong as it has ever been, with The Devil Wears Prada 2, The Mandalorian, Grogu, Toy Story 5, live-action Moana, and Avengers Doomsday all on deck. 4. The Experiences segment delivered record quarterly revenue of $10.01 billion, up 6% year on year, and record operating income of $3.3 billion, plus 6% year on year, ahead of expectations. Domestic parks, the bread and butter of our core thesis, saw revenue of $6.9 billion, up 7%, with operating income up 8%, driven by attendance up 1% and per capita spending up 4%. Looking forward, indicators remain strong, with Walt Disney World room bookings pacing plus 5% weighted toward the back half. Management expects modest Q2 operating income growth due in part to, quote, international visitor headwinds, which looks nothing more than a cyclical noise to us, with full-year operating income growth still tracking high single digits. 5. Disney's cruise expansion continues to pay off, with the Disney Destiny launching during the quarter to strong demand and outstanding guest reviews, followed by the more recent launch of Disney Adventure, bringing the total fleet to 8 ships. 5 additional ships are scheduled beyond fiscal year 26, setting up cruises as a meaningful contributor to experiences growth for years to come. While management doesn't break out the segment separately, they continue to highlight its attractive margins and the highest guest satisfaction scores across the entire company, which translates directly into significant pricing power. 6. ESPN remains the industry leader in sports, capturing 30% of all sports viewership across all networks in Q1, greater than 30%. Sports revenue came in at $4.91 billion, up 1% year on year, with operating income of $191 million, down 23% year on year, impacted by a $110 million hit from 15-day YouTube TV blackout. The launch of ESPN Unlimited is off to a strong start, with management encouraged by app authentication rates from pay TV subscribers, the pace of new signups, and engagement patterns. Disney also closed its acquisition of NFL Network, including Red Zone and other NFL media assets, with the NFL's 10% stake in ESPN valued at $3 billion. The upcoming NFL season will also end in ESPN's first ever Super Bowl broadcast, seen as a massive opportunity. 7. CapEx during the quarter totaled $3.01 billion versus $2.47 billion last year, with greater than 70% attributable to the domestic experiences segment. Full year CapEx remains on track at $9 billion for fiscal year 26, driven primarily by cruise ship fleet expansion and new theme park attractions, with expansion products currently underway at every theme park globally. Returns on invested capital for the experiences segment remain highly attractive, leading the company across all segments. 8. Free cash flow was an outflow of $2.28 billion versus an inflow of $739 million the year prior, driven mostly entirely by timing-related tax payments related to California wildfire relief deferrals. Most importantly, management continues to now expect $19 billion in operating cash flow and $10 billion in free cash flow for the full year. 9, management is on track to repurchase $7 billion worth of stock for the year, 4.1% of the market cap, already having bought back $2 billion during the first quarter, combined with a dividend of $1.50 per share, 1.6% yield at current prices. Total shareholder yield stands at 5.7%. And 10, management reiterated confidence in double-digit adjusted EPS growth for fiscal year 26, weighted to the back half of the year, driven by entertainment operating income growth and the double-digit range. Sports up low single digits and experiences up high single digits, all important double-digit EPS growth target for fiscal year 2027 also remains firmly on track. You can find the earnings call and key highlights transcript also at hedgefundtips.com. You can scroll down on the right side and you'll see under popular articles. Fear and greed down at 18. That tends to be when you get paid to be a buyer. You'll get some volatility into the weekend. But these levels, you get paid to at least nibble on red days until the thing turns. And when it turns hard. Congratulations to all the new clients that came in intra-quarter Q1 with larger sized accounts and those existing clients who upsized their contributions to their accounts. We're reopening now. We've been taking in clients to get their applications through so they could get money to work by April 1st, and they're already doing that. Those interested in going live should begin onboarding right away. To see if you qualify and take advantage of this opportunity, either go to hedgefundtips.com and click on money management, or just go to greathillcapital.com for more details. Larger accounts, the 5 and 10 million plus, can access bespoke service anytime. The smaller accounts, the 1 million, we only open up once a quarter, and that is now. We'll probably close out on April 10th or sooner. So we'll make that announcement next week. REITs, top 30 weights, earnings estimate revisions, revised down by 79 basis points for this year, revised down for 70 basis points next year. Utilities earnings estimates, top 30 weights, revised down 9 basis points for this year, revised up 24 basis points for next year. Key economic data, I think here you got to watch this 30-year mortgage rate. Has been no bueno since the Iran war, and interest rates have spiked because of the increased costs. It's also not helped private credit, obviously. It's not helped rate cut expectations. But this is all man-made, like last year's Liberation Day. Starts with a tweet, ends with a tweet. And you saw a taste of what that looks like on Monday. I think you're going to see more of that to come. Initial jobless claims came in a little bit better than expected. Continuing came in a little bit better than expected. So the job market is hanging in there. Expectations for earnings growth this quarter up to 12.5%. It was only 11% last quarter. And you can see for the years, they just keep going up. 367 for this year, 316 for this year, 367 for next year. Now we're going to get to our incredible audience questions for Ask Me Anything questions. And the first one comes from Gaspard Bidot with ENXTPA. I have no idea what this is, but let's see if it exists. ENXTPA. Oh. Edenred. Okay, that's a French company. All right. Cash flow is recovering. Revenue seems solid. That's good. Buying in shares. What do they do? Digital platform for payments. Yeah, the only payments company I like is PayPal. I think this potentially works, but I don't know the business well. I like the numbers, so on the numbers basis alone, I think it's worth doing more work. But as it relates to PayPal, to payments, we want one with a huge embedded base because there's going to be a lot of change, and the bigger players are going to be able to navigate it better. Clorox, I like it. That was easy. Terry Smith, GDRX. If this is an individual, GoodRx Holdings. Yeah, this is like an app to save money on drugs. Yeah, I just don't know what the moat is for this business. So for that reason, I'm out. On a financial basis, I understand why you're interested, but I just don't know, like, why can't it be replicated by 100 people? So for that reason, I'm out. Young S. Yelp. No. Pass. JD. I mean, Yelp. It's just an advertising platform. I'm sure the financials look okay, but it's not. This thing is probably going to bounce. Let me just take a quick look at it for you. Yeah, I mean, I do think you're going to get a bounce. Obviously, the margins have been contracting. It's competitive space, but you're probably due for a technical bounce. It's not a business I would want to own for a long time. Rob Wart is asking about Estee Lauder. It's fine. We haven't added any Estee Lauder. We might. I want to get some more clarity on what that deal looks like, if it's going to happen. Baxter, we continue to add on red days. That one we're fine with. Hitter is going to turn that around. And when it turns, it's just going to be like 15, 20 points overnight. Justin Thompson, Anta Sports on the Hong Kong Stock Exchange. We don't buy. The only Chinese stock we're really willing to buy is Baba. Because what's going to happen is China's going to get a bull market, and you're going to buy all this stuff, and half of them are going to turn out to be accounting frauds, and you can't prepare for that. So with Alibaba or Tencent, they're kind of too big to fail. The rest of them, I mean, you saw Luckin Coffee. I just wouldn't want to own a lot of individual stocks over there on that basis. Andrew Z, thoughts on Gartner? This is a software play. It's going to bounce with software for sure. Like all of these software stocks, the financials look good, but you don't really know what the mode is. So you can play it for a technical bounce. Owning it for the long term, probably not. But yeah, it's going to bounce when the market turns. Tim Cowan, SSP. EW Scripps Company. Maybe I can just save this so I don't have to keep doing it. Is this the TV company? Yeah, this is a terrible business. Yeah, portfolio television stations. This is buying horse-drawn carriages. I don't want to be in this business. I think it's going to work on a technical basis, but no thank you. It's kind of like playing the Gannett. Buffett used to play the newspaper runoff business, and it never really worked. Young asks about Mosaic. I think you probably missed this one, my friend. Welcome to the pod. Oh, no, not yet. Okay, let's take a look. MOS. I mean, it's just a super duper cyclical business. I like this for the commodity cycle for sure. I think you're probably okay here. I'd like a little bit more. Let's see what they're doing quarterly, and a bit of a turn on the free cash flow. I'd wait for the first quarter that this thing turns free cash flow positive. They've been buying in stocks. Debt's a little bit burdensome, so you definitely want to see when this debt's going to mature. Margins have been under pressure. It's that time in the cycle for these guys. I think long term you're probably okay. I think short term you want to wait for a quarter of free positive cash flow. Jimmy Jones. He's asking a technical question on Diageo. Diageo is, I mean, it's funny. I was in the airport last night. I'm like, oh, I guess no one drinks anymore. Literally, I'm walking by every restaurant, every bar, everything. Literally, I couldn't tell you the number of martini glasses I saw. It's like people are drinking more than ever. And by the way, it's interesting about Diageo. Yeah, they screwed it up, but this guy's going to fix it. That fixed Tesco. But, at the end of the day, yeah, you had this insane once in a lifetime. People were trapped up and scared and drinking more than ever during COVID in 2022. They had cash and they had nothing to do but drink. But look what's happened. Even so, you would think that revenues are down like 50%. They're basically flat with an all-time peak of 20.52. They're at 20.25. Still generating high single digit, low double digit return on invested capital. Still trading at 11 times earnings. Debt's a little bit more than you would like. Obviously, that's an issue. Share count has come in a little bit, but not enough. But in the scheme of things, it's generating $2.5 billion of free cash flow. That gives it a lot of optionality. They can sell off assets. They have a lot of outs. People are still drinking based on this huge emerging market growth. China hasn't even come back in this regard because of the corruption crackdown. And they're still able to hold this together at this level. And you get the stock down 50%. Plus, we add on this on red days. I think we bought some this morning or yesterday. Daniel Borkman was wondering, what is your take on a potential Fannie Mae, Freddie Mac IPO? I have no idea. I'll leave that to Bill Ackman to guess when that's going to happen or try to influence the administration. He's been saying it's going to happen for 5 or 10 years. It hasn't happened. Maybe now, with his nice tweets about the Trump administration, he'll get it done, but I wouldn't hold my breath. Rick Tarps, that's gambling anyway. It's like, oh, Hedge, you win, great, you're so smart, but otherwise you're just bagged in it. And Rick Tarps, Melly. All right, let's see here. Yeah, this is like the Latin American Amazon. I think you kind of get 2 bites at the apple here. The issue is I wish it was down a little bit more. I'd probably be a buyer at like 12.50. It's at 16.50, down from 26. It just hasn't come in enough for me to get a double or triple over a few years, but I think this is a great business at a so-so price. I'd rather have a great business at a good price, and I think a good price would be down, 13, 14, 1500, and you may not get it. So I agree with everything you're looking at, and it has pulled back, but I need a double or triple over a few years to get interested. Jared Fenton, OFLX. Yeah, so they missed earnings. No change. I think it's fine. It's just going to take longer than everyone expects. Brian SQ, he's asking, what do you think after the quarter? So you think in 2 weeks, I think in 2 years. We're different, okay? And when you start to adopt, I'm not talking to this one person, I'm talking about the royal you. When you adopt a longer term view for good cash flowing businesses that are turning around and you can get a sense of their moat, these become enormous opportunities. So the key with all these is zooming out. So I guess, here's someone who bought it at 37, it dropped to 30. This thing, it might take a few years to build a base, but it'll work back up to 80, 100 over time. In my view, I just think it's going to be much longer than most people think. It's going to take 10 cents. Is fine, but I think you get more bang for your buck with Baba. Supermicro, SMCI. Didn't they just put this guy in jail for selling NVIDIA chips? No, hard pass for me. Not yet. Next, that's a broken Momo stock, meme stock, I guess would be a better way to say it. Loam Van Dam, awesome podcast. Universal Music Group. Let's see. I don't like these businesses, but let's take a look. Yeah, I mean, share count's gone up modestly. I see what you see. The price is down materially relative to the underlying fundamentals. What do they do here? Operates a music company worldwide, recorded music publishing. I mean, if you're going to buy this stock, you're probably close to the area that you would want to buy it. I personally wouldn't want to buy that stock. I don't like the business enough. Blah, blah, blah. Save. Okay, thanks for that, Agathan. That I was able to use that. I remember you sent that in. And GPN, yeah, this is payments again. The only one I really want is BABA, but if you look at these numbers objectively, they also look pretty attractive. And with that said, let's take a look here. Yeah, the difference is their share count's been rising versus falling. And their free cash, their revenues have been hit more. PayPal still keep growing, albeit modestly. So for that reason, I prefer PayPal. I think you could probably make some money off of this, but I think your moat is less entrenched. So with that said, I want to thank everyone for tuning in. We'll be back next week. Same time, same place. In the meantime, make it a great one. Bye for now. Pause your video player to review our terms and disclaimer. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Great Hill Capital LLC or PPI is not under any obligation to update or keep current the information contained herein. Great Hill Capital LLC or PPI and its respective officers and associates or clients may have an interest in the securities, derivatives, or entities referred to in this material. Great Hill Capital LLC or PPI accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.